listening to that testimony today from Jay Powell, what do you think are the market implications for investors here? Is there anything that he said that was not priced into the market?
Not really, not today, but it's continuing down this path that he and Clarida and Coral and all of the Fed members have talked about being, I call it the yoga Fed now, being patient, being flexible around responding to the data, which I think is the right thing. Listen, I think the difference between this year and last year, the reason why this is so profound, is you now have what is a more symmetric Fed. Rates aren't going to go very far from where they are today. If you're investing in equities, you're investing in commodities, whatever you're investing in, the fact that you had to worry about for 2 years rates moving higher, persistently higher, that's gone. And I think it's a big deal. So now when you think about, do I hold interest rate exposure into my portfolio against maybe my equities or otherwise, you can do it. It's part of why equities, you don't have that ugly, ominous, gosh, we're going to see the discount rate continue to rise. It's a big deal.
There's a bit more certainty. And he did get into a bit of explanation surrounding the inflation mandate. And you recently wrote that you believe the drivers of inflation are misunderstood. And without an inflation mandate, what should the Fed be looking at, do you think?
So, I mean, one of the things I've said that I think is really important, inflation volatility is at an 85-year low, meaning you don't have to do a lot. You can be patient, that we're actually at a level, we think core CPI could head up to 2.25, maybe 2.30. It's not that scary at all. What drives inflation tends to be demographics and technology. Both are pressing down on inflation. The Fed's at no risk. In fact, one of the things I thought was interesting, the last CPI report showed a little bit of growth in inflation. People said, oh, here it comes. Actually, if you took out California on CPI, it was a 1.6% top line CPI. California contributed about 50 basis points of it because you obviously had the fires and you had a dynamic with regard to transportation and utility costs, et cetera. Meaning, if you take the rest of the country, it was only 1.1% inflation. It's not scary. And quite frankly, the Fed has more tools to deal with inflation than they do deflation. Let it go a little bit, and that's where I think they're going to go from here.
Powell not overly, but somewhat optimistic about the economy and the contours of it, while noting that there were some risks that he's paying attention to, largely overseas. But a bunch of our guests today that we've spoken with, Cooperman, Rubenstein yesterday, Lasry, all saying that they don't believe a recession is imminent, but potentially a downturn or some sort of slower growth environment. How do you view the contours of the economy right now?
Listen, I think the economy's slowing. I mean, there's no doubt when you look at we look at our cargo data, we look at aircraft data, the economy's slowing. That being said, we grew at a very quick pace last year. You had a bunch of fiscal stimulus, monetary stimulus, other factors that were driving the economy. By the way, the rest of the world was growing pretty significantly. I think going forward, we're going to slow to potential, which is around 2%. I think there's something really important. Historically, when we thought about a recession, you had a manufacturing-oriented economy. When all of a sudden you close the output gap, inflation grew, and then the economy slowed and went into a recession. Today, you don't see that. All the hiring's in services, things like education, healthcare. It's not an economy that's that sensitive to boom bust like you saw historically. It's one that we're going to have an unemployment rate that's 3.5%. The consumption is 70% of the economy. It's going to continue to grind along. So slower, but pretty good for a while. And other than it seems about time we have a recession, I don't know that there's another reason why we should have one.
And Powell mentioned that, especially as it relates to the oil economy. I think we have a question back at the NYSE. Wilfred?
Hey, thanks, Leslie. Rick, I'm interested in what you make of what the other major central banks have said in the last 6 months and how they've changed their tone, because it's interesting, despite the much more dovish tone from the Fed over the last 6 months, that the dollar index is kind of broadly flat, staying around that 95, 90, 96 level. What's your take?
So I'd say a couple of things. First of all, I think the data, and part of what Jay Powell's talked about, which I think is right, the data in the rest of the world is a lot tougher than it is. The data in Europe, it continues to be rough. The data in China has been slowing considerably. I actually think it will start to stabilize, particularly China will start to stabilize post this deal. Listen, one of the things that I think has been surprising recently is you've had a Fed that has been on autopilot, has been moving rates higher, the dollar appreciated. I think, and it's hurt the emerging markets quite a bit. I actually think that dollar appreciation, for the most part, has, we can grind up a little bit, but I think for the most part is gone, which is a big deal for markets, big deal for emerging markets, equity markets. But I think the dollar appreciation, I think we've seen the move we're going to see there.
Rick, Morgan Brennan here. The Fed has this dual mandate, right? Inflation and full employment and managing and controlling both of those. We've been focusing a lot on inflation, especially as the Fed, and I know Chair Powell talked about this today to Congress, considers reassessing its framework to that. But the comments from him today also about the fact that perhaps there is more slack in the labor market than had previously been I guess, regarded when you look at the labor force participation rate. What does that do for Fed policy as well? And how should investors be thinking about that piece of the puzzle?
That's a great question. It's a big deal. I mean, there has to be slack. We're getting jobs reports of 300,000 jobs when you have an unemployment rate that's under 4, been under 4, and you've hired I think it's 18 million people in the last 10 years. The numbers are staggering, but we're going to keep seeing it. We're going to continue to see job growth, but it's a hugely important thing that it's a service-oriented economy. Part of what we talked about, healthcare, education. You're seeing these sectors, leisure, you're seeing these sectors that continue to need people. There are more jobs available than there are actual people today. And by the way, I don't think that's going to change much. It's going to moderate a little bit. But, quite frankly, I think the Fed should just let that go. Why do we want more people employed? As long as you're not creating inflation. Wages used to create inflation. They don't today. So let it go. And, you can let the economy continue to grow, hire more people. We're putting more debt on the economy. There's no reason to hire more people, and let that manifest itself for a while.
Rick, Powell also addressed this idea of MMT, modern monetary theory, which essentially means that if there isn't, much in the way of inflation, that the government can run up a higher debt tab and larger budget deficit as a result. What do you make of this theory? What do you make of his comments in response to it, which pretty much said that, we shouldn't be running up our debt tab, without bounds, without limits?
So, I have a somewhat different take on there's been a lot of papers written recently about we can absorb more debt, we can take on more debt. I think that is a difficult paradigm when you talk about where we are today, where the debt has grown. When you think about if inflation were to rise, you would certainly have an issue in terms of debt costs would move up. If we moved up the cost of the debt, it is a problem. By the way, the thing we saw in the last quarter for sure was a crowding out effect. When the Treasury has to issue immense amounts of debt, it crowds out. You saw this play out in December in profound manner. That what happened was interest rates moved up. People said, gosh, I could be in the 2-year Treasury at 3%. Why do I need to buy high yield? Why do I need to invest in equities? There's a crowding out dynamic that is profound. And so when people say, gosh, I think we can absorb more debt in the country, I just think that is a very dangerous thing because it tends to drag on the economy in a multitude of ways. I think there's a level that you can run the debt at. And to be reserve currency in the world, which is hugely powerful for the United States, we've got to be really thoughtful about, with entitlement spending growing and the debt burgeoning, the burgeoning debt levels in this country, you've got to be really careful about it. So I think some of these papers recently, I may push back on a bit.
Are you concerned at all by the pause in the Fed's policy with regard to interest rates, and what would happen if a significant slowdown did happen with regard to the toolkit that, whether it's on the fiscal side or the monetary side, that our policymakers have to really kind of lift us up? Is there enough of a toolkit that could really help?
So I think the ECB, per Wilfred's question, the ECB's in a tough spot because you're at negative rates and you have a tough time buying more assets. Fed has a tremendous amount of tools left at their disposal. By the way, real rates have moved up a couple hundred basis points. You can cut rates. You have the ability to do more quantitative easing. By the way, the balance sheet of the U.S. people talk about a lot is $4 trillion-ish. It's 20% of GDP. It's 40% in Europe, and it's 100% in Japan. Fed can do QE. Fed can do more in terms of moving interest rates. They can talk a lot about where they're going to go in terms of policy. So the point being is I think the Fed has a huge amount of tools at their disposal. And I think the reason for pausing makes a ton of sense. There's no reason to keep hiking when the economy's slowing. Let it go. We're close to the neutral rate. You're seeing areas like housing that are softening a bit. They can pause, and there's no reason. They have plenty of ammunition from here.